Welcome to the Everything Financial Radio program. We are here every week at this time. I am your host, Dennis Tubbergen, and I'm sure glad you tuned in today. If you are a regular listener, welcome back. I've got a terrific show lined up for you today. Mr. Ian Gordon of the Long Wave Group will be stopping by. It's been several months since we talked to Mr. Gordon, so we are going to get his take on what's going on. Also, this past week, one of the architects of the euro said it's time to break it up. The currency is a catastrophe. We have to stop. Also, the country of Greece, no longer considered to be a developed country by the MSCI index. They relegated the country to emerging market status. And believe it or not, in spite of all the regulation that has taken place since 2008, when the too big to fail banks were bailed out, derivatives exposure at the big banks are higher than they were just 5 years ago. In the last segment of today's program, I'll explore that, tell you what a derivative is, and how this may affect you and how it may affect your nest egg. So you'll certainly want to stay tuned for that as well. We will be talking to Mr. Gordon here momentarily, but before we get to that interview, let me remind you of just a couple things. First of all, we are conducting a class called New Retirement Rules. We have had a terrific response to the class. It's all about educating you. We believe the best financial advice comes from you. If it doesn't seem right to you, it's probably not right, and we believe that you should educate yourself. So that's what the class is all about. It's a 3-night class, 3 Thursday nights in a row. It's $49 to cover books and handouts. That covers all 3 nights. You can go to the website, newretirementrules.com, to get more information if you'd like. You may also register there as long as capacity remains. Again, the website, newretirementrules.com. Also, if you'd like to go back and listen to any of the interviews, or re-listen, I should say, to any of the interviews we have with our guest experts, including the interview today with Mr. Gordon, there are a couple ways you can do that. You can go to the website, everythingfinancialradio.com, and click on the archive section, or you can go to the iTunes store and simply search under Everything Financial Radio, and you can download all the interviews there as a podcast. I'm very pleased to have back on the program with me today Mr. Ian Gordon. Many of you who have been listening to the Everything Financial Radio show for any length of time know Ian as the president and founder of the Long Wave Group. Very prolific writer and commentator. And Ian, it's a pleasure to have you back on the program today.
Well, Dennis, it's always good to be with you.
Ian, we were talking a bit before we started this interview that certainly when one looks at the mainstream media headlines, it seems that the economy's stabilized. It seems that housing is rebounding, is going to lead the U.S. anyway out of the economic doldrums that we've been experiencing. What's your take on all this?
Well, I think that the appearances sort of belie the reality, Dennis. And yeah, you know, there has been a rebound in housing, and I think a lot of that is coming actually from hedge fund purchases and so on, so that there's a lot of money going in where people think they're picking up cheap housing and then hopefully selling it on forward at a higher price. And really, you know, I think the issue that everybody has to understand, the principal issue that is in the economy is the debt. And that issue hasn't been taken care of. And that's really, you know, the fundamental problem for the economy is the overriding debt in the economy, whether it's consumer debt, financial debt, and when I talk about financial, I'm talking about the banks and insurance companies and so on, their debt, just corporate debt at large, or government debt. I mean, those kind of, that massive amount of debt that pervades not only the U.S. economy, but European economies and so on, hasn't really been addressed at all. And in fact, what has happened is to try and sort out the problem of debt, the governments have been creating even more of it. And so essentially that overhang of debt is eventually going to from my perspective anyway, and from my perspective as a student of the long wave, is going to absolutely blow up the economy. So I think even though there may be an appearance that things are looking better right now, that underneath that they're actually getting worse. So the whole thing is sort of decaying underneath, and when it does blow up, and I suspect it will blow up within a few months or so, then things are going to get really bad indeed, because there'll be no more kind of solutions that the governments can resort to try and cure the real problems of the economy.
Ian, as you were talking, one of the things I thought of was the fact that Prime Minister Abe in Japan has, over the last 6 or 7 months, engaged in money printing at what I describe as just a maniacal pace. And it appears that maybe some cracks are starting to show up in the foundation of the Japanese economy. Seems that we've seen the long-term declining trend in Japanese government bond interest rates now spike. Is this really the market now starting to come to the realization that there's just so much debt out there, this will never be paid? Is Japan heading down the same road that Greece did a few years ago?
Well, I mean, Japan is sort of a different animal than Greece. I mean, it has a very large economy, but it has substantially more debt than Greece. I mean, Japanese government debt is about 250% of the Japanese GDP, and the problem for Japan and in what they're trying to do is to sort of try to reintroduce inflation into the economy by printing copious amounts of money, is that their interest rates are rising, and that becomes a huge cost factor for the Japanese government. And the other thing is that in Japan, most of the debt up to this point in time has been funded internally. In other words, Japanese banks and the people themselves have actually bought Japanese debt. So much of it has not been funded outside of Japan. But now, with this growing amounts of debt that they are creating in Japan, more and more has to be funded outside. And that means that when you do that the interest rates have to rise to satisfy the risk that the foreign purchasers of Japanese debt perceive. And so this is going to become a major cost factor to the Japanese government's budget. Just the interest rates alone, rising interest rates are going to be crippling to the Japanese budget. So, yeah, I think that's a sort of an issue in itself, and the whole Japanese economy could blow up on this mad scheme that the Prime Minister sort of has dreamt up to try and reintroduce inflation, because Japan has effectively been going through a deflation since its stock market started to crash in late December 1989. These are the kinds of desperate measures that governments essentially are resorting to try and get things going on an even keel. But we could say that the whole issue, really, Dennis, is it's a paper money issue. And you're creating massive amounts of paper money to try and reignite an economy that's dying.
Ian, we've got about 2 minutes left in this segment, and you are a very serious student of economic history as well. In past economic winter seasons, when we've seen high debt levels, is it possible, is there any strategy that a policymaker or politician might utilize to escape the deflationary forces of debt?
I really don't see that. I mean, actually, in the last depression, they were effective in escaping the deflation by simply moving out of the gold standard, off the gold standard system, and moving into a pure fiat paper money system. So, in the last depression, the world monetary system collapsed between 1931 and 33, when the world was effectively on a gold standard system, and all the countries sort of bailed out of gold so that they could print money to fight the depression, and in so doing, they were able to create inflation, to get out of the deflationary spiral that they had been in, and move back into a sort of an inflationary scenario. Unfortunately, this time, we've been in a paper money system, and even, so we're trying to create massive amounts of paper money to keep ourselves out of going into the deflationary spiral. But this time, the debt is so overwhelming, it's much, much bigger than it was in the 1930s. And the real debt in the 1930s was essentially, there was a banking debt and so on, but most of it was national debt issues, because that had sort of been developed during the First World War, so countries had gone into excruciating amounts of debt to fight the First World War. But the consumers themselves weren't heavily in debt, particularly in Europe. The American consumer did take on a fair amount of debt in the Roaring '20s, and that also brought down the U.S. economy in the '30s and forced a depression. So, but the debt this time is so overwhelming. It's like $200 trillion worldwide, the total debt. And it's just that I don't see any way that you can print your way out of it.
Well, we're going to leave it there, but we'll continue our conversation with Mr. Ian Gordon of the Long Wave Group when Everything Financial Radio returns. Stay with us. Welcome back to the Everything Financial Radio program. We will continue our conversation with Mr. Ian Gordon of the Long Wave Group in the next segment. When we start talking with Mr. Gordon and we talk about the debt levels that still exist in the economy, it's easy to lose sight of this fact. We hear reports that the housing market is improving, the stock market's at new highs, and yet underneath this surface of success, or this illusion of economic success, debt levels are still growing. In fact, in the last segment of today's program, I'm going to talk about derivatives. For those of you that aren't familiar with derivatives are essentially debt on debt. And you'll be surprised to learn that the derivatives market actually has grown in spite of the fact that some of the regulatory action taken after the meltdown of 2007, 2008 was designed to eliminate, or I should say limit derivative activity. It has not done that. When you look at debt all around the world, it is taking its toll. In fact, this past week, the Wall Street Journal reported that Greece, the country of Greece, was removed by MSCI Inc. from its list of developed countries and relegated the nation to emerging market status. This from the article, the latest setback for Greece, MSCI Inc. booted the Eurozone member from its index of developed countries. The decision, announced last Tuesday, is the first time the index provider demoted a country from its developed to its emerging market category since the launch of its flagship Emerging Markets Index back in 1987. That's 26 years ago. Now, this simply affirms what a lot of investors have believed for years, according to the journal article. Multiple bailouts by the EU and the IMF, a sharp contraction in gross domestic product in the country of Greece, and still huge levels of debt, which is kind of the theme of this week's program, mean that Greece now has more in common with Hungary than France. Now, according to MSCI, Greece failed to qualify as a developed market based on several criteria, including the ease with which money managers can trade shares on the country's stock market. Now, the government of Greece is continuing to struggle making its debt payments. It's trying to raise money by selling off assets, kind of like someone that lost their job, walks through the garage or walks through the basement to see what they might be able to sell to raise some cash. That's what Greece is doing. However, they're not very successful at this. On Monday this past week, Greece put up for bid its natural gas monopoly. Nobody wanted to buy it. Here is an energy monopoly in the country of Greece, and there were no bidders. Now, this is no surprise. Greece was classified really as a developed market only because their affiliation with the euro. And while Greece's stock market has rallied since the first of the year and pulled back here this month, longer term, I share Mr. Gordon's view, and we'll get his take on this in the next segment, that the outlook for Greek stocks as well as stocks in general is negative. Staying with what's happening in Europe, a gentleman by the name of Oscar Lafontaine. Some of you may remember him as the German finance minister who actually helped launch the euro. Here was one of the masterminds behind this common European currency. Well, this past week, Mr. Lafontaine came out and said in a Telegraph article that the euro is a catastrophic currency and it needs to be broken up. This from one of the architects of the euro. He said the economic situation is worsening from month to month, and unemployment has reached a level that puts democratic structures ever more in doubt. Those are strong words. Unemployment has reached a level that puts democratic structures ever more in doubt. Now, Mr. Lafontaine said on the parliamentary website of Germany's left party that Chancellor Angela Merkel will awake from her self-righteous slumber. Pretty strong words. Once the country's in trouble, unite to force a change in crisis policy at Germany's expense. He said the countries in Europe that are hurting are going to turn the tables on Germany. Well, his prediction appeared confirmed this past week as French Finance Minister Pierre Moscovici proclaimed the end of austerity and a triumph of French policy. The French Finance Minister said, "Austerity is finished. We're done tightening our belt. This is a decisive turn in the history of the EU project since the euro," he was quoted as saying on French television. He said, "We're seeing the end of the austerity dogma. It's a victory of the French point of view." Well, austerity will return to France because the markets will dictate it. Debt does not go away. Breaking up the euro won't make the debt levels go away. It will just denominate the debt differently. Even when currencies have failed historically, in fact, at our class New Retirement Rules, and we've got a brand new class starting in July. You can go to the website newretirementrules.com to get more information. We examined 4 different historical time frames when currencies have failed, when policymakers have attempted to print money, when debt excesses got too high, and in every circumstance, deflation followed. You see, deflation from excess debt simply can't be avoided. The French may think they have scored a victory here short term, adding liquidity to the system, which is incidentally what the U.S. Federal Reserve is doing, trying to add liquidity to the system, trying to add money to a system faster than money leaves the system through defaults. But when debt levels reach excessive levels, you can't avoid deflation. That's a structural issue, to use an economic term, and it's not solved by adding liquidity to the system. So easing austerity measures, breaking up the euro, all these potential solutions to a really dire debt problem may provide a temporary reprieve for debt-laden countries. However, history teaches us that ultimately debt excesses lead to deflation and to pain, and it's our view that we will see a deflationary time frame, and it's our view that stocks will not like deflation. So if you'd like another perspective as to what you might consider doing with your nest egg in light of these circumstances and opinions, I would invite you to go check out the information that you'll find at the website newretirementrules.com. We'll return in the next segment and continue our conversation with Mr. Ian Gordon. Stay with us.